Central banks are the buyers, and they've got huge war chests of foreign currency reserves, plus they can print their own money and use that to buy gold. And I don't think the central banks are that price sensitive. I mean, sure, they don't want to run the price up. They want to buy it. Their goal is to have more gold. Their goal is not to sell any of this gold. So they're not trading the gold. The central banks who are buying this gold, if gold rallies $100, $200, they're not going to flip it. They're not day traders. They need the gold. These are long-term reserves for their currencies. The only time they'll sell this gold is if they have to, if their currencies are under attack and they need their gold to shore it up. This gold is disappearing from the markets. It's not going to be out to trade.
The price of gold continues its upward trend, reaching around $2,165 during the early European session on Friday. This surge to a record high is attributed to a combination of factors, including a weaker US dollar and a decrease in US Treasury bond yields, bolstering the appeal of gold as a safe haven asset. Moreover, anticipation of the Federal Reserve's first rate cut in the June meeting is driving further demand for gold. Prominent American stockbroker Peter Schiff observes that while it took some time for gold to hit a new record high, he foresees a continuous pattern of breaking these records in the future. His belief in the ongoing rise of gold prices is rooted in various factors, including the current economic climate and market dynamics. On a global scale, central banks significantly contribute to the gold demand. According to the latest data from the World Gold Council, central banks collectively increased their gold reserves by a net 39 tons in January. Turkey emerged as the largest buyer during this period, adding 12 tons to its reserves, bringing the total held by the Central Bank of Turkey to 552 tons. China's central bank also continued its gold buying spree, marking the 16th consecutive month of accumulation in February. This sustained purchasing has led to a notable increase in China's official gold holdings, now at 2,245 tons. This figure represents a substantial rise since October 2022, when the People's Bank of China resumed reporting its gold purchases. Peter Schiff underscores the significance of central banks in the gold market, noting that despite retail investors selling off, central banks maintain significant reserves and are actively accumulating gold. He emphasizes that short-term price fluctuations do not sway these institutions and instead prioritize the acquisition of gold for long-term reserves, indicating sustained support for the precious metal. Let's delve into key moments from Peter Schiff's interview with these video clips.
The last record high was December of last year, so it took a few months for gold to make a new record high. I don't think it's going to take much longer to continuously break these records, because I do think that we're headed higher for the price of gold. I don't really expect to see a significant correction from here. I think we will get a bit of a correction, but I think it's going to start from a higher price. I think we're now kind of broken free from that low trading range. And I pointed out on video from yesterday, what is extremely unique about this, and I actually saw a chart. I don't have it to show here, but I did an interview earlier in the day, and somebody put up this graph of the inflows and outflows from GLD and compared that to the gold price. And it went to the rally in 2011, the rally in 2020, and the rally now. And the prior peaks, as the gold price was rising, there were big inflows into GLD, which would make sense because one of the reasons that the gold price was going up is because the people were buying. Money was coming into GLD, and then GLD took that money and bought gold. But also, if you look at historically, the way retail investors tend to trade is they buy high and they sell low, which of course is the opposite of what you're supposed to do. But human psychology means that people get excited when prices are going up, and they expect that the trend will continue, so they want to hop on board. When prices start to fall, they get nervous that prices may keep falling, and so they want to get off. And this is what the pattern has been until now. This rally is the first rally to new highs where the public is not participating. In fact, for weeks, actually months, leading up to the new high, the public was getting out of gold. So they're missing the rally. I think that's a great contrarian indicator. And I think that's a sign that this rally has legs. Because normally the market peaks when you get a rush of buyers that come in. And now the market gets overbought, it gets saturated, and then there's a correction to kind of flush out the weaker longs. Well, with this rally, there are no weak longs to flush out because they already took themselves out. The other thing I pointed out, which I think is very encouraging for this rally, is that the buyers have very deep pockets. Because if the retail public has been getting out of gold, and there's no real sign that that exodus has continued, they may still be selling. But the central banks are the buyers, and they've got huge war chests of foreign currency reserves, plus they can print their own money and use that to buy gold. And I don't think the central banks are that price sensitive. I mean, sure, they don't want to run the price up. They want to buy it. Their goal is to have more gold. And their goal is not to sell any of this gold. So they're not trading the gold. The central banks who are buying this gold, if gold rallies $100, $200, they're not going to flip it. They're not day traders. They need the gold. These are long-term reserves for their currencies. The only time they'll sell this gold is if they have to. If their currencies are under attack and they need their gold to shore it up. So this gold is disappearing from the markets. It's not going to be out to trade.
Gold has continued its impressive ascent, marking its 7th consecutive day of gains characterized by higher highs, lows, and higher closes. However, a slight deviation has been noted over the past 2 trading days. In the initial 5 days of this rally, the surge in gold prices was primarily attributed to market participants, with the strength or weakness of the dollar having minimal impact on the overall change in gold. Nevertheless, the dynamics shifted over the last few days, with the uptrend in gold prices predominantly fueled by dollar weakness. Yesterday, dollar weakness contributed nearly half of the net gain in gold prices. Today, however, it's noteworthy that dollar weakness accounted for all the gains in gold. Prominent investor Peter expresses personal enthusiasm regarding the current buying opportunity presented by gold and mining stocks. They reveal a significant allocation of their funds into these assets, anticipating further gains in the future. Let's get back to the interview.
Silver is half of its high. Why? Because the public is selling silver and the central banks aren't buying it. They're not there to take the other side of the trade. So silver's a steal. And the same thing with the mining stocks. The reason that Newmont and some other mining stocks got clobbered, but gold didn't, is because the central banks aren't buying the mining stocks. That's not what they want for reserves. They want the actual gold. And so that's what they're buying. But the point that I want to make now that I didn't make yesterday is that if the supply that the central banks are absorbing is coming from retail investors, where are these central banks going to source their gold when the retail investors stop selling? Because eventually they will. And in fact, eventually they'll start buying again. Maybe at much higher prices, but they will start buying. And I think even more importantly, at some point, institutional money is going to come into the gold market because it's been AOL the whole rally. Pension funds, endowments, hedge funds, they're not buying gold. They will, but the point is when all of these buyers who are on the sidelines join the foreign central banks and buy gold, who's going to sell them the gold? You know, there's not a lot of gold being mined. I mean, there is gold, and I own these mining companies. And so Newmont Mining and Barrick Gold, they will sell gold to the central banks. They will sell gold to investors. But there's not enough of it because the gold industry has not been investing in building out new mines. They've been shutting mines down. They've been paying off debt. They've been consolidating and cutting costs and trying to stay ahead of rising mining costs. Because again, inflation has driven up the cost of mining gold much more than it's driven up the price of gold. So that's been bad for a lot of these gold miners. And also, there hasn't been a major discovery of gold in, I can't even remember when, 10 years, 20 years. I mean, normally every few years, somebody discovers a bunch of gold. But no one's discovered any. So you have a situation where the market is undersupplied and it's about to run into a huge increase in demand. And what does that tell you? That means that the price of gold has a long way to go to catch up to clear that market. Gold is very undervalued right now, and it has been for some time. And that is the opportunity to buy it before it's repriced to a realistic valuation, which is many times higher than it is now. And then once gold gets to a fair value, then I expect it to appreciate gradually over time as the dollar and other fiat currencies continue to depreciate. But the real opportunity for an investor like myself or whoever is listening is in these mining stocks, because there's a complete dichotomy here. I mean, these stocks are not priced for the reality of where gold is, let alone where it's going. And so they're still really cheap. And I'm still waiting for the day when these stocks go up 10, 20% in one day. I think that day is coming, and it may be coming soon. But before it does, that's a better time to put more money to work. I mean, I put a lot of my own dry powder to work last week. And in fact, I depleted the cash I had because I was so excited personally about the buying opportunity that I bought what I could.
Lastly, what other factors could potentially impact the future trajectory of gold prices, and how might investors navigate these uncertainties in their decision-making process? Share your thoughts in the comment section. If you liked the video, please subscribe to our channel, and remember to activate notifications by hitting the bell icon. Your participation means a lot to us. Thank you.